Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial statements of America's biggest companies. And sometimes you find out exactly where the money is going, or maybe where it is trying to hide. Today we are diving into a report from the Lord Abbett Private Credit Fund. It is a bit of a different one, and we're going to see how this fund is doing. Before we get into the nitty-gritty, if you like getting the real story behind financial filings without all the corporate jargon, hit that subscribe button. Also, we have a fantastic Discord community linked in the description where you can chat with us and other viewers about these reports. Now, let's get to it. This filing is about a new credit facility. Think of it as a big loan setup that this fund has entered into. Essentially, they've secured a way to borrow up to $300 million. This is significant because it gives them more firepower to make investments, or maybe to manage their day-to-day operations. This facility is set up with Royal Bank of Canada, or RBC, as the main bank handling it. It is designed to be a revolving credit facility, which means they can borrow money, pay it back, and borrow it again, like a credit card, but on a massive scale for businesses. Now, let's talk about the cost of this money. They'll be paying interest, and for us dollar loans, it is tied to a rate called SOFR, which is a common benchmark rate. On top of that, there is a margin, which is like an extra fee, that can range from 1.60% to 2.00% per year. This margin depends on the kind of investments they're using as collateral. They also have to pay a fee if they don't use all the money they have available, kind of like an annual fee on an unused credit line, but it is structured in a few different phases over the loan's life. What is really important here is that the fund's obligations under this loan are basically secured by everything they own. All of their assets, including their portfolio of loans and debt investments. The lenders have a first priority claim on these assets. This means if things go south, the lenders get paid back before anyone else. It is a common practice for these types of financing deals, essentially putting their whole company on the line for this financing. Now, shifting gears a little, there is some news about the fund selling more of its own shares. They've issued and sold over 2.3 million shares, bringing in about $58 million. This means they're raising more capital from investors. The price per S-share was $25.2. This sale was done through subscription agreements, and they're saying it is exempt from needing to formally register these shares with the US Securities and Exchange Commission or the SEC, because they believe they're selling only to accredited investors, which are individuals or entities meeting certain income or net worth requirements. Here is where we get to see what the fund is actually doing with its money. As of the end of November, they had lent money to 37 different companies, had a stake in one company, and were involved in one joint venture. The total amount they've committed to lend is a massive $1.29 billion, with about $1.036 billion actually being used by these companies, which is the par value. Most of their investments, 94%, are in senior secured debt, meaning they are one of the first in line to get paid back if a company defaults. Only 6% is in that joint venture. It's good to see that 100% of their debt investments are at floating rates, which means as interest rates rise, their income from these loans should also rise. Let's look at some key metrics for these companies they've invested in. The median earnings before interest, taxes, depreciation, and amortization, or EBITDA, for these companies is $70 million. This is a common way to measure a company's operating profitability. The weighted average net leverage, which is basically how much debt a company has compared to its EBITDA, is 4.7 times. This means on average it would take these companies about 4.7 years of their operating profit to pay off their net debt. A lower number here is generally better, indicating less risk. The weighted average loan to value, or LTV, is 42%. This metric tells us how much debt they've lent relative to the estimated value of the assets securing that loan. A lower LTV provides a bigger cushion if the asset value decreases. The weighted average interest coverage ratio is 2.3 times. This means on average, these companies generate 2.3 times the amount of EBITDA needed to cover their interest payments, which is a healthy sign for their ability to service their debt. Finally, the weighted average yield on their debt investments, meaning the return they expect to get on the money they've lent out, is 9.5% at cost. This is a pretty attractive yield, especially in the current market. Here is a quick look at their loan activity in November. They made new commitments totaling $107.5 million, and their actual loans, or par value, increased by $73.8 million. Companies like Excursions Buyer, LLC, and Arcus Bidco Limited received significant funding during this period. Good news for the shareholders. The company has declared a distribution, which is like a dividend of about $0.22 per S-share. This will be paid out in January. This shows the fund is generating enough income to return some profits to its investors. And finally, the fund's net asset value, or NAV. as of the end of November was around $471 million. The NAV per S-share was $25.2. This NAV is essentially the total value of the fund's assets minus its liabilities divided by the number of shares outstanding. It is a key measure of the fund's worth, so what is the story here? Lord Abbett Private Credit Fund is actively expanding its lending capacity with this new $300 million credit facility. They're also bringing in new capital through share sales, which is a positive sign of investor confidence. The fund's portfolio is concentrated in senior secured debt, which is generally considered a safer bet in the credit markets, and they are earning a respectable 9.5% yield on their investments. The companies they are lending to seem generally healthy, with decent leverage and interest coverage ratios. The potential risks are always there with any lending business, especially in a fluctuating economic environment, and the fact that their obligations are secured by all their assets means there is a high degree of commitment. However, the increasing borrowing capacity and capital raise suggest a strategy of growth and expansion, aiming to capitalize on lending opportunities. Alright, that is our breakdown of the Lord Abbett Private Credit Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.